Imagine walking into a store with absolutely no money in your pocket. You grab a coffee, a new pair of shoes, maybe even a brand new laptop. You walk to the checkout, tap a small piece of plastic, and just like that, you leave with everything. No cash, no waiting, no bank transfer, just one tap. It almost feels like magic. But here's what most people don't realize. Every single time you use a credit card, someone is making money. Not just your bank, the store, the payment network, sometimes even the company whose logo is printed on your card. And when you multiply that by billions of purchases happening every single day around the world, you begin to understand why the credit card industry generates hundreds of billions of dollars every year. But that raises an interesting question. If banks are lending people money to spend, why would they ever want to do that? Why are they willing to give complete strangers thousands of dollars in credit? And if they're handing out cashback, airline miles, free hotel nights, and luxury airport lounges, where is all that money actually coming from? The answer is much smarter than most people think. To understand it, we have to go back to a time before credit cards even existed. Back then, shopping looked completely different. If you wanted to buy something, you needed cash. There were no taps, no Apple Pay, no online shopping, and definitely no rewards points. If you didn't have enough money with you, you simply couldn't buy what you wanted. In smaller towns, however, there was another option. Local shop owners often knew every customer personally. If they trusted you, they'd let you take the item home and simply write your name and the amount you owed in a notebook. You'd come back days or weeks later to pay them. Your reputation was your credit score. It worked because everyone knew everyone. But as cities grew larger, people became strangers. Large department stores couldn't personally know thousands of customers. Businesses needed a system that allowed people to buy now while still protecting the seller from losing money. The world was waiting for a better solution. And surprisingly, that solution began because of one embarrassing dinner. In 1949, a businessman named Frank McNamara went out for dinner with some colleagues in New York City. Everything was going perfectly until the bill arrived. He reached into his pocket and realized he'd forgotten his wallet. He couldn't pay. His wife had to come and rescue him by bringing the money. For most people, that would have been nothing more than an embarrassing story to laugh about later. But Frank couldn't stop thinking about it. What if people never had to carry cash again? What if there was one card accepted at multiple businesses that allowed you to pay later instead of immediately? The very next year, he created the Diners Club card. It wasn't made of plastic. It was actually cardboard. Around 200 people received one, and it only worked at a small number of restaurants. But despite how simple it sounds today, it introduced a revolutionary idea. Buy now, pay later. People loved the convenience, and businesses loved attracting more customers. It wasn't long before banks noticed something much bigger. If people borrowed money, banks could earn money. In 1958, Bank of America launched one of the first large-scale bank credit cards. But there was one huge problem. Instead of waiting for customers to apply, they mailed tens of thousands of cards directly to people's homes without asking. Imagine waking up one morning and finding a credit card in your mailbox that you never requested. That's exactly what happened. Many people immediately started spending. Fraud exploded. Some people disappeared without paying. Banks lost millions of dollars. For a moment, it looked like the entire credit card idea was going to fail. Instead of giving up, banks learned from their mistakes. They introduced applications, credit checks, credit limits, fraud monitoring, identity verification. Everything became much more secure. As technology improved, so did the system. Eventually, credit cards spread across the world and became one of the most common financial tools ever created. Today, billions of people own at least one credit card. But here's something fascinating. When you tap your card at a store, the bank doesn't instantly send money to the merchant. In reality, an incredibly complicated process begins behind the scenes. First, the payment terminal sends your card information to the merchant's bank. That request then travels through payment networks like Visa or MasterCard. Those companies don't actually lend you money. Instead, they act like giant communication highways that securely connect thousands of banks around the world. The request eventually reaches the bank that issued your credit card. Within a fraction of a second, your bank checks whether your card is active, whether you have enough available credit, whether the purchase looks suspicious, and whether there are any signs of fraud. If everything looks good, the bank approves the transaction. That approval travels all the way back through Visa or MasterCard, returns to the merchant, and within only a few seconds, you're walking out the door with your purchase. The actual money usually moves later through a process called settlement. It all feels instant, but behind that simple tap are multiple companies communicating in milliseconds. By the way, if you're enjoying the video so far and you've learned something new, take 2 seconds to hit that like button and subscribe to Explained Under 10. We break down complicated topics just like this into simple, entertaining videos that anyone can understand, and it really helps support the channel. All right, now let's answer the biggest question of all. How do banks actually make money? Most people assume it's just interest. And yes, interest is a huge part of it. If you don't pay your balance in full by the due date, the remaining amount begins collecting interest. Depending on your card, that interest can easily be 20% or even higher every year. Someone carrying a balance month after month can end up paying hundreds or even thousands of dollars in interest alone. But that's only one piece of the puzzle. Every single time you use your credit card, the business you're buying from also pays a small processing fee, usually somewhere around 2 to 3% of the purchase. So if you spend $100, the store might only receive about $97 or $98. That small percentage gets divided between the merchant's bank, the payment network like Visa or MasterCard, and the bank that issued your card. It might sound tiny, but now imagine billions of transactions happening every single day around the world. Those tiny percentages become enormous amounts of money. Banks also charge annual fees on premium credit cards. Some of the world's most exclusive cards cost several $100s every year, while a few luxury cards cost well over $1,000 annually. So why would anyone willingly pay that much just to own a credit card? Because many of those cards come with benefits that can easily be worth even more. Unlimited airport lounge access, travel insurance, rental car protection, free hotel upgrades, priority boarding, concierge services, purchase protection, extended warranties. For frequent travelers, these benefits can save far more money than the annual fee itself. Banks also make money through foreign exchange fees when you shop in another currency, late payment fees if you miss your due date, cash advance fees when you withdraw cash using your credit card, and partnerships with airlines, hotels, retailers, and reward programs. Which brings us to another interesting question. If banks are making so much money, why do they give you cashback? Why do they give away free flights? Why do they offer thousands of reward points just for signing up? Surely they aren't doing it out of generosity. The truth is much simpler. They want one thing. They want you to choose their card every single time you make a purchase. Because every time you swipe their card instead of someone else's, they earn merchant fees. The more you use their card, the more valuable you become as a customer. That's why banks compete so aggressively with sign-up bonuses, travel rewards, cashback offers, and exclusive perks. They're all fighting for one very important place, your wallet. Now here's the interesting part. If you pay your balance in full every month, never miss a payment, and take advantage of the rewards, you can actually come out ahead. You build your credit history, earn cashback, collect travel points, receive valuable protections, and never pay a dollar in interest. In many ways, you're using the system exactly as it was designed, but without becoming one of its most profitable customers. On the other hand, if you constantly carry a balance, make late payments, or spend more than you can afford, those same benefits disappear very quickly. The rewards you earned can easily be outweighed by interest charges. That's why some people absolutely love credit cards, while others end up trapped in debt. The card itself isn't good or bad. It's simply a financial tool. Used wisely, it can save you money, build your credit, protect your purchases, and unlock valuable travel perks. Used carelessly, it can become one of the most expensive financial mistakes you'll ever make. The next time you tap your credit card, remember that you're doing much more than simply buying something. In just a few seconds, multiple banks, payment networks, merchants, and financial systems work together to complete that single transaction. It's one of the most sophisticated financial systems ever built. And now you know exactly how it works. Thank you so much for watching, and I'll see you in the next episode of Explained Under 10.